The market doesn't know what keeps you up at night. It doesn't know when you want to retire, and it doesn't know how old you are. The simple truth is, the market doesn't care. But if you care, you've tuned into the right place. You're listening to Investor Resources, bringing clarity to the confusing world of finance. Here are your hosts of Investor Resources, Don Creech and Perry Sykes.
This is Don Creech.
And this is Perry Sykes. Welcome to the Investor Resources podcast.
So we are talking about diversification today, and the market, in fact, is defying diversification in many ways. The evidence of that can be found by looking at one of the very common, most traded, exchange-traded funds, the triple Qs, the Invesco 100. While this has been driving up markets, been participating in one of the areas that has been strong in the market, it has some real defying data. In the bottom part of this panel, the red line indicates the number of stocks within the triple Q that are in declining patterns of price. And the green line represents the number of stocks that are in upward panels. So even within the Qs, there is a significant dispersion in quality and direction. The index may go up, but there's a bunch of the stocks inside that are not participating. Basically, 7 companies have kept the S&P 500 and the NASDAQ afloat this year. That's Apple, Meta, Microsoft, NVIDIA, Amazon, Alphabet, and Tesla. They're driving the vast majority of the gains. So
if you're investing in one of those indexes looking for diversification, you're not getting it right now. The diversification has gone away because the concentration in these mega cap tech stocks pulls all of the weighting to the top of the index, and everything else is just going along for the ride.
People think they're diversified, but you can
Correct.
see by looking at the graph that's on here, Apple is almost 18% of the S&P 500, Microsoft 14%, and then you have Alphabet. And NVIDIA has had a recent rise, gave up a bunch of the gains one day. But this is the extent of your diversification. The rest of the market has been struggling actually since the summer of 18. Granted, we have had some rally along the way, but it has not been consistently spread. As I was thinking of doing this, Perry, I was thinking of the old Listerine ads. You have bad breath, use Listerine. Well, what we really have here is bad breadth. We have to put a D in the middle of that. And that is the problem that we are facing here today. We take a look at the risk decomposition, because we've been taught in the industry and as investors, you need diversification to manage risk. And yet people want to buy technology, and we aren't getting the normal diversification factor that people assume they are getting. This shows the risk component of the top 10, top 20, and the S&P 500. And people focus on concentrating into technology, and it has destroyed the normal portfolio construction process.
Right. So again, when you're looking at that, you're not looking at like the S&P 500. You're not seeing what 500 stocks are doing. You're seeing what 7 stocks are doing, and that's what's moving the index. So it is significantly more concentrated than most investors are thinking.
So if you want to create an equally weighted portfolio of stocks that would provide the same level of diversification as the market cap weighted S&P index, how many stocks would be in that hypothetical portfolio? The number is called the effective number of constituents. And the answer is 60 stocks. That's as of June this year. Because the S&P is so highly concentrated, it isn't providing any more diversification than a portfolio of 20 equally weighted stocks, according to this measure. The other diversification problem that has developed with the concentration in equities has turned out to be the breadth issue. Not enough stocks participating where you can actually diversify your risk factor. Again, with the latest data as of June 30th, The stock bond mix, which people have been trained to use for the last 40
Sure.
years, modern
Yep.
portfolio theory, 60 stocks, 40 bonds, or something close to that, is supposed to provide you with downside protection. Not that you sell stocks, but the bonds are supposed to hold up the portfolio value, reduce your emotional response to bad markets while you hold your breath, buy and hold, hang on for the long term.
Right.
Except that's not happening now. In this
And
chart, it shows the correlation between these two theoretically offsetting assets
sure, and
is
that
not
bad
working.
breath, the way it reduces risk most of the time is it increases volatility radically because instead of waiting for 500 securities to move, or in the NASDAQ, at least 100 securities to move in the triple Qs, you're looking at 7. That's it. That's all you're getting as far as diversification goes. So you're actually not diversified at all. You're in a very concentrated position. And on any bad news, any headline trading, that's going to affect the value of your portfolio significantly. So you have nowhere near the diversification that you're thinking you do once you invest in that index.
So what are you supposed to do if you have
Yeah,
a modern portfolio theory structure? Wait it out. When
that's it.
bonds are
That's it.
supposed
Yeah.
when bonds are supposed to be your protection, and yet they have the worst year of performance in 100 years and provide no protection but have massive losses, you're still supposed to hold your breath while you have bad breath. It doesn't
sit
seem to
sit
make any
tight and
sense.
do nothing. Yeah.
So, having figured this out more than a decade ago, after the 08, 09 market, we went back and said, there's got to be something wrong because this process didn't work in 08 and 9 to protect client accounts. We know it didn't work in 2000 with the tech bubble
Sure.
bust.
Yep.
What's wrong? Well, what's wrong is it's a marketing theory. It looks good on charts, but it doesn't actually represent the way people manage money. And there's no academic support for it working unless you are a multi-decade long investor before you need your money. Might be okay if you're in your 20s, 30s, but if you're already in your late 50s, 60s, 70s, or 80s, being a long-term investor doesn't look very prospective. I mean, it is not the answer. So we basically use relative strength. That's our RPM system. Returns are a function of price and momentum. And if you don't have momentum, you're not going to get a decent price, which means your returns will be hurt. If you want to find out more about that, you can go to our website or give us a call. We offer a second opinion on your portfolio. Send us a list of your tickers and we'll do an analysis from our point of view instead of from the standard industry sales pitch. Our contact information is there. We'll look forward to having you with us on our next podcast. Have a great day.